Dear students, welcome to this lecture video. Here I will go over discounted cash flow analysis, or DCF in short, for the Procter & Gamble company. So I'm going to do this analysis based on financial statements of 2022. In your case, you will do it based on the most recent published financial statements. I have already downloaded the income statement data here and balance sheet data here from the SEC website. You have to do the same, meaning you have to download the most recent financial statements data from the SEC website. So now I am coming back to the template so that you have to use, which you have already used for quiz problems and homework problems. So first task is net operating assets, which is operating assets minus operating liabilities. So here I will calculate operating assets. If you need to refresh your memory, I have the textbook open here. These are considered operating assets that are directly linked to the company's ongoing business operations. These are considered operating liabilities. And it also mentions that if there is something less other assets or other liabilities, consider them to be operating, unless there is specific information saying otherwise. So, equal sign, I have to sum. So this is the formula I'm going to use, and assets are on the balance sheet. So I'm going to balance sheet. So my first operating assets are accounts receivable. So this cell, comma, inventory, that is the total number, comma, and then prepaid expense, yes. Assets current, that is the subtotal, so I'll ignore this one. Property, plant and equipment, yes. Goodwill, yes. Intangible assets, yes. Other assets, yes. So that's it. Now, operating liabilities. Enter equal, sum, open parenthesis, go to balance sheet again. For liabilities, accounts payable, yes. Accrued liabilities, yes. Debt, no. Deferred income tax, yes. Other liabilities, yes. Okay, that's it. So now I have to find out net operating assets, which is operating assets minus operating liabilities. Next, our net non-operating obligations, which are non-operating liabilities minus non-operating assets. So non-operating liabilities, again, you can go to the textbook to identify those. Equal sum balance sheet non-operating liabilities. So our liabilities start here. So this is our first non-operating. This is the subtotal. I'll ignore this one. Yes. So that's it. And then non-operating assets. So sum, I'll go to balance sheet again. Assets. So cash. So that was the only one we left out previously for operating. So that is our net non-operating obligations. Now NOPAT, net operating profit after taxes, which is net operating profit, profit before tax minus tax and operating profit. So net operating profit before tax. So which will be sales. So I'll go to income statement. Sales minus cost of goods sold. This minus operating expenses minus this. So in other companies' financials, you may see multiple lines of operating expenses. So in that case, remember to subtract all operating expenses. In this case, we have only just this item. So this is my net operating profit before tax, which is the same as operating operating income in this company. So now tax expense is again from income statement, which is income taxes. Okay. Now pre-tax non-operating expense. So enter sum, open parenthesis, go to income statement. So non-operating expense. So interest expense, of course, is non-operating expense. And then, so this is an income. That's why positive. Now here, other non-operating, it says income. If it is income, it will be positive. If it is expense, it will be negative. So this number is positive. So it is an income. So we will not include it in the expense. So this is our only expense, non-operating. Close parenthesis. Now, one thing I would like to mention here, be careful about the signs they are using. Different companies follow different convention. For example, here they have used negative sign because it is an expense, but some companies may use a positive number even for an expense in their financial statements. So to avoid this kind of complexity, I'm going to take the absolute sign. So I'm going to remove the negative sign of this number. So in Excel, you can use this function called ABS. So that returns the absolute value of a number. So if it is negative, it will make it positive. Okay. Now pre-tax non-operating income, so equal to sum non-operating income. So this is an income, so I'll include this one. And also this is income. I'll include that one too. But again, although we don't have to we have a positive number, but to be consistent, I'm still going to use absolute value formula. So you can consistently use these, calculate this way for your company. Now, pre-tax net non-operating expense, which is pre-tax non-operating expense minus pre-tax non-operating income. So now we have a negative number. So now statutory tax rate, I'm going to use 22%. And then tax on operating profit. So this will be our tax expense, which is this plus open parenthesis pre-tax net non-operating expense, which is this times statutory tax rate. Okay, now our NOPAT, which is operating profit before tax, this minus tax on operating profit. So these are some of the information we will need. Now for DCF, we are going to use, make some assumptions. In the ideal case, in DCF analysis, you will actually forecast revenue growth. And based on those forecasts, you will calculate total revenue, and you'll also forecast NOPAT and net operating assets. For our case, we are going to use something called parsimonious method. What that basically means, we will forecast only the revenue. And I am using these forecast numbers from the textbook. Again, if you go to the textbook, on module 13, you will see this is module 11. I'm going to module 13, where the DCF is. So these are the forecasts we are going to use, and this is a parsimonious model. In the full model, you will see it's taking a while to refresh. This is a full model. They have forecasted not only sales, but also NOPAT and net operating assets. So for these two, we're going to use the historical, we are going to base our forecast on historical information. So there is a detailed analysis here of the parsimonious model. So let's go back to our Excel. So we are going to forecast only the revenue. So here for the next 5 years and the terminal period is, we think, starting in this period, revenue will grow at a constant rate forever. Now, instead of forecasting NOPAT and net operating assets for all these years, what we are going to do, we are going to use these two pieces of information: net operating profit margin, net operating asset turnover, calculated from the most recent year. For my case, it is the 2022. In your case, it will be 2024 or a different year. So So let us do that. First of all, net operating profit margin, which is NOPAT, divided by sales. So I have to go to income statement, sales. Okay, 18.27. And net operating asset turnover, which is again sales, divided by net operating assets. Okay. Now, my revenue for 2022 fiscal year, A means actual, E means estimates. Enter equal sign, go to income statement, select this cell and hit enter. And then I'm going to use those growth rates. And pull across. NOPAT. This. Now, if we know NOPAT and if we know the revenue, if we know the revenue, which we have forecasted, and remember I mentioned we are going to use these two historical numbers to forecast NOPAT and net operating assets. So we are going to do it now. So for example, if we know the revenue, and this is our net operating profit margin, and we are assuming this will stay the same for our case. So this will be then our revenue times this net operating profit margin. And because we are going to use the same percentage, I'm going to lock this cell. So this is what is meant by locking a cell. You enter a dollar sign in front of the column name, which is C, and row number, which is 27. And then hit enter. Pull across. Now, net operating assets is this. And we are going to use, again, the sales information and net operating asset turnover. So it will be sales divided by net operating asset turnover. Lock this cell, hit enter, pull across. Okay. For this problem, we are using a terminal growth rate of 2% for this company and discount rate of 6.4374%. Shares outstanding, net non-operating obligation. So which we have already calculated here. So now this is our actual valuation template. So our NOPAT again is this much. So let me do this. So I'm going to delete this. I'll bring the NOPAT from this table so that I can pull across. Our NOPAT for 2022 is this, and then I'm going to pull across. I'm going to select without formatting. Similarly, net operating assets and pull across. Now increase in net operating assets, so which is current minus previous. And then free cash flow, which is our notepad minus increase in net operating assets. We will start from 2023 because remember, price means the present value of future cash flows. These are the future cash flows. This is not a future, this is today. Now discount factor, which is actually derived from the discount rate, which is 6.434%. So 1 over 1 plus the discount rate raised to the power of year. So 1 over, open parenthesis, 1 plus, this is our discount rate, lock it, close. Now raised to the power is this symbol. I want to, instead of manually typing 1 for this year, 2, 3, 4, and so on, I'm going to use the formula. For example, count, starting from here, and go to this. And then close. Now I'm going to lock this cell. So only this cell. And then because for this column, I need E to D. So this will remain fixed. Only this will move when I pull across, right? And I'm using the same cell because I want the count to be 1 for this year. But when I move across, so this will remain the same. This will change to E46. So then I will get two cells, right? So, okay, hit enter. So you're good, pull across. Now I don't need this one. I'll delete this one. Present value of horizon free cash flow to the farm, which is your free cash flow multiplied by your discount factor. Let me use some formatting here. Okay. Now, cumulative present value of horizon free cash flow. Horizon free cash flow means these 5 years. So sum of these 5. And then present value of terminal free cash flow to the farm. Terminal. So what that basically means, so this is our terminal free cash flow. And this will increase at a constant rate of 2%. So basically that means it is a increasing perpetuity. So if you remember from our module 12, let me pull up. Where we talked about dividend discount model. So this is the formula. If we have a constant perpetuity. But if we have a growing perpetuity or increasing perpetuity, this is the formula to use, right? So we are not working with dividends and we are working with free cash flow. That is the problem, but the math remains the same. So our cash flow next year divided by our discount rate minus the growth in the discount rate. Now, also remember when you have, when you calculate, or to calculate the present value today, which is this 0, you need the cash flow after 1 year, right? So coming back to our Excel, so that is why we need this one to find out the present value at the end of 2027. So what we are going to do, we are going to calculate the present value of all these future cash flows, constant increasing perpetuity, constant growth, increasing perpetuity. We are going to find the present value at the end of 2027. Then we have to bring that 2027 present value to this period by multiplying by the discount factor. So let us do this one step at a time. So the first step is to find out the present value of this free cash flow to the firm at the end of 2027, which is our free cash flow divided by, open parenthesis, our discount rate minus the growth rate. This. Now this stands at the end of 2027. To bring it to present, we need to multiply this by the discount factor. So I'm going back there. I'm going to wrap this in parentheses, multiply by our discount factor. You can see the formula here, hit enter. Then my total farm value will be the sum of these two. Now we have to subtract this net non-operating obligations, which is, we already found out here. And then preferred stock. Let's see if we have any preferred stock in the balance sheet. We have, yes, we have preferred class B. Actually here, these numbers. Preferred stock stated value issued 843. So these are in millions. So 843 million, right? So I'm going to DCF, enter equal sign, balance sheet. This is my preferred stock value. These are per share value. This is number of shares. So I need just this one. Less non-controlling interest. Do we have a non-controlling interest? Yes. So enter. This is our non-controlling interest. Okay. Now equity value is my total farm value minus NNO minus preferred minus non-controlling. Okay. So that is the total value of common stock. Now we have to multiply, divide by the number of shares. So in millions, because all these numbers are in millions. Let me change the decimal format for this to no decimal. So now where can we get the shares outstanding? So we can also use our SEC website. So you need a different financial statement for this. So after you click on this link, so let me go to the PG website. And then if I go to filings, 10K, I'm working on 2022. Interactive. And then you need shareholders equity statement. And then you will see in shares, common stock, this is 2019. So this is your common stock, ending balance. This is this number, right? It's just one number. You don't have to copy the entire statement. So I'm going to paste this number here. Now we have to convert this in million, right? So I'm going back there, enter equal in front and divided by, and these numbers were in shares in thousands. Okay, so we have to divide by, they're already in 1,000, so I just need to divide by another 1,000 to find it in millions. So now par value, stock value per share will be total value divided by number of shares. And as of 2022, I will write down the current market price. So it will be the current market price as of your date when you do the DCF. So so that is it for DCF for this company, and you can also go back to the textbook for more discussion on this, right? Chapter 13. If you have any further question. So here, now you will see they have a different number here because this is based on full forecast, right? But we are using parsimonious method. That is one. Another thing you will notice, even for the actual year, this number actually, only this number is different, slightly different from our number. Our net operating assets is actually 71,133, and they have net operating assets of 71,933. That is because they actually go into further details to separate some of the line items, which I ignored to keep it simple. So, but if you do that, then you will actually arrive at $137.52. So that is it. I hope this helps you to do the DCF on your own company. Thank you very much. Bye.